Sure. Well, let's take a look at some of the metrics within Los Angeles. You've got a 12% unemployment rate today versus national average of 9%. On the good side, there is an improvement in non-retail and retail construction, but it's going to be slowed down. Any kind of growth is going to be slowed down, though, by high job costs, high employment costs, so it's going to be a slow recovery. You do see, though, you've got an improved sales per square foot in the retail sector. Occupancy cost has gone up 20%, or 20 basis points rather, so that's improving. But it's really in the grocery anchored side that's seeing that growth. So within Los Angeles, even though you've got a bit of diversity with income and diversity in employment, the real growth is going to come from the necessities and the frequent trips to grocery anchored centers. I would expect places like Santa Monica Place and the Grove, to the same extent Americana, to outperform because of the experience that they generate for the consumer. It's a different environment that you have at most shopping centers, where you're going to pull people out of the house just to have a common place to sit down, have a coffee, and meet. And by the way, they might do some shopping on the way, which is of course the goal. But what those places do uniquely is create a fun environment that has just a different experience altogether than most shopping centers. You're going to find that some of the even spots on along Melrose and Beverly Hills, even though you don't have money to go out and spend the money there, it's still a great experience to walk and see the window dressings and the shopping experience. They're just so different. I do expect those to outperform, and the numbers have proved that out in the last year with the high-end retailer doing really well. I think that the institutional investors are going to target pretty much the same core class of assets in 2011 as they did in 2012. They're looking to minimize their risk, get a consistency with tenants. So that's basically grocery drug anchor centers where they've targeted their money last year. I think they'll do that again in 2012. What those centers offer are a relatively diverse tenant base. You get frequent trips, so you know you're going to have to get the staples at the grocery store, the drugstore, your dry cleaners. They're going to get those basic staples out of the way. And those cap rates in 2011 were extremely low. You know, some of the highest traded assets, certainly here in Los Angeles, were trading somewhere in a sub-6 area. So very competitive. The next group of assets that institutions are looking at are high street tenants. That's Beverly Hills, West Side, and then you can say Union Station or Union Square rather than San Francisco, Dallas, New York. And that group of assets has a history of productivity, great creditworthiness. You know, they've got a track record that they can bank on, and so they're looking at buying just single buildings out of those high-end streets. So low end, frequent trips, and then the high end, you've got creditworthy stability there. So those are the two groups that they're looking at, I think, on 2012. So yeah, it's a very fair question. The savings rate could have a significant impact. Since May of 2010, it's been a slow and steady decline, and I've heard arguments on either side on it's a good thing or a bad thing. So on one side, you could say the savings rate's declining because it's a sign of confidence in the marketplace and people are willing to spend money. On the other side, you could say they're having to spend this money because unemployment is still very high, and then they need to spend out of their savings just to live and survive. So each one of us, when we read the data points, are going to make our own assessments of how that comes down. And there's good news and bad news on either side. So the consumer confidence is down to a point what it was 2 years ago. But I think an encouraging number for retail is that since February, we've had a 1.1% month-over-month increase in retail sales. So that's very encouraging. I think really it's coming down to you've got to have the discretionary income to fuel the retail growth. It's going to come from frequent trips, the grocery anchored drug centers. It's the middle market that people might have a little bit of a hard time justifying spending the money. But really, you know, for whichever side you come down on, it all comes back down to just jobs and being comfortable with your job. You're going to go and spend that money you have. Here, the demand on real estate in the future is going to be significant, and we're already seeing that today, where retailers are shrinking their footprint from 30 to 25,000 square feet, from 10 to 7,000 square feet, to adapt to the presence of online, and not just online, but mobile shopping also. And the fear used to be that you just go into a store and on Black Friday, and you'd shop around, and you'd go back on Monday, and you'd buy it online through another retailer site. Well, now it's happening with the advent of mobile phones. You can go and shop right there and buy it right there with your phone. So the customer interaction is changed dramatically. Forrester Research estimates that in 2016, the sales online were about $30 billion, up from about 10 today. So it is significant. What we're seeing now is a really exciting time with retailers. They're changing the interaction with the tenant, or sorry, with the consumer, to capture that sale right then. You're having more opportunities to buy the product right there, as opposed to having someone come and snap the product and have it shipped to their house. So that's a very exciting time for retail, having to reinvent themselves. On a go forward, what does it look like for landlords and or retailers? It's how do we design space that's more flexible and functional, considering you don't know what the retail needs are going to be in the future. So maybe not as deep, maybe they're a little narrower. So where's inventory going to be held? Those things are going to be worked out in the next few years, and it's not known today because this is such a huge impact on what online's doing. But the interaction between the bricks and mortar with their retailer customers is changing in ways that we wouldn't have expected without that competition from online. It's pretty exciting.